To illustrate, assume that on June 22 of the current year, Marco's company is considering leasing or disposing of the following equipment. So we have alternative 1, that is leasing, and alternative 2 is to sell. If the equipment is sold, differential revenues will decrease by $60,000. So that is alternative one, $160,000 less $100,000 for alternative two. So the total will be a loss of $60,000. A differential cost will decrease by $29,000. So that is the cost for alternative one is $35,000, while alternative two is $6,000. So the overall cost will be $29,000. So now the differential effect on income is a decrease of $31,000. Thus, the decision is to take alternative one, which is to lease the equipment. Discontinue a segment or product. A product, department, branch, territory, or other segment of a business may be generating losses. As a result, management may consider discontinuing or eliminating the product or segment. So for example, product K has revenue of $65,000, variable cost of goods sold of $50,000, variable selling expense of $12,000, and fixed cost of $25,000, creating a loss from operation of $22,000. We prepare a differential analysis dated February 22 to determine if product K should be continued or discontinued, assuming fixed costs are unaffected by the decision. So for alternative one, as stated, the revenue is $65,000 and the variable cost is $62,000 since we add up the cost of goods sold plus the selling expense of $12,000 of alternative one, and the fixed cost is $25,000. So the total cost is $87,000. So we less the revenue with the total cost, we will have a loss of $22,000. So same process with alternative 2. Um, However, in alternative 2, we don't have a revenue since we will be discontinuing the product and no variable cost. So we only have a fixed cost for alternative 2 or when we discontinue the product K. So when we compare uh, a loss of $25,000 versus a loss of $22,000. So definitely, the company would choose to continue product K since it will only have $22,000 at a loss. So now we proceed with the next part of the differential analysis, which is the make or buy. So companies often manufacture products made up of components that are assembled into a final product. The manufacturer must decide whether to make a part or to purchase it from a supplier. So we have an example for the make or buy. A company manufactures a subcomponent of an assembly for $80 per unit, including fixed costs of 25 per unit. A proposal is offered to purchase a subcomponent from an outside source for $60 per unit, plus $5 per unit freight. So we prepare a differential analysis dated November 2 to determine whether the company should make or buy the subcomponent, assuming fixed costs are unaffected by the decision. So here, for the make subcomponent, we have variable costs of $55 per unit. So that is the $80 per unit to assemble the subcomponent plus the fixed cost of 20 less the fixed cost of $25 per unit. So that is $55 dollars per unit. And we have the fixed factory overhead of $25 per unit. So overall, we will add up the variable cost and the fixed factory overhead. So we will have a loss of $80 per unit for the make subcomponent. So for alternative number two, to buy the subcomponent, so we have $60 per unit since we will be purchasing from an outside source company. So we also add up the freight cost, which is $5 per unit, and the fixed factory overhead, which is $25 per unit. So as you can see, we have a loss of $80 for the make subcomponent and $90 for the buy subcomponent. So therefore, it is best that the company will make subcomponent, so that is alternate to choose alternative one. So next we go with replace equipment. The usefulness of a fixed asset may decrease before it is worn out. For example, old equipment may no longer be as efficient as the new equipment. So here we take into consideration the value of an equipment over time. So a machine with a book value of $32,000 has an estimated 4-year life. A proposal is offered to sell the old machine for $10,000 and replace it with a new machine at cost of $45,000. The new machine has a 4-year life with no residual value. The new machine would reduce annual direct labor costs from $33,000 to $22,000. So we prepare a differential analysis dated October 7 on whether to continue with the old machine or replace the new machine. So um, so for alternative one, we have to continue with the old machine. So the direct labor here is of 4 years. We compute this one by um, $33,000 times 4 years. So that is $132,000. And for the alternative two, we do the same, which is $22,000 times 4 years. So we have $88,000. So then we just add the total cost of the purchase price and direct labor. So for alternative one, we have $132,000, while the total cost of alternative two is $133,000. So again, we less the revenue to its cost, so we can have the total income or loss. So for alternative one, we have $132,000 loss, and alternative two is $123,000 at a loss. So overall, the differential effect on income for alternative one versus alternative two is $9,000. So therefore, the old machine should be sold and replaced with a new machine. Another differential analysis is the process or cell. So during manufacturing, a product normally progresses through various stages or processes. In some cases, a product can be sold at an intermediate stage of production, or it can be processed further and then sold. So next, we go to the process or sell example. So product T is produced for 2.50 per gallon. Product T can be sold without additional processing for 3.50 per gallon, or processed further into product V at an additional cost of 0.70 per gallon. Product V can be sold for $4 per gallon. We then prepare a differential analysis dated April 8th on whether to sell product T, the alternative 1, or process it further into product V, the alternative 2. So now we still follow the same process to less the revenues with the cost to have to to gain the to know the income or loss per unit. So for the alternative one, the revenue is 3.50 per unit, and we less the cost per unit with 2.50, so the income is $1 for alternative 1. And for alternative 2 is the revenue is $4. We less it to 3.20. So that is the 2.5 per gallon of product T plus the 0.70 per gallon of additional cost for product V. So that is that's why it's 3.20. So the total will then be 0.80 dollars of income per unit. So um, as you can see, the income is higher for alternative 1 comparing alternative 2. So therefore, the best decision for the company is to sell product T. So lastly, part of the decision a differential analysis is accept business at a special price. So the differential cost of accepting additional business depend on whether the company is operating at less than capacity. If the company is operating at less than full capacity, then the additional production does not increase fixed manufacturing costs. So we now have another example for the accept business at special price. So product D is normally sold for 4.40 per unit. A special price of 3.60 is offered for the export market. The variable production cost is $3 per unit. An additional export tariff of 10% of revenue must be paid full for all export products. Assume there is a sufficient capacity for the special order. Prepare a differential analysis dated January 14 on whether to reject or accept the special order. So here, since we reject the order, we have no revenue. So this is for the alternative 1. And we don't have the cost for variable manufacturing costs, also the export tariff, and we don't have any income since we've rejected the order. So for the alternative number 2, uh, which is the to accept the order, so since we have a revenue of $3.60 as stated in the example, the data, and then we have a cost of $3 for the variable manufacturing, and then we compute the export tariff by 36 $3.60 times 10%. So for the um, export tariff, so we have a total cost of $3.36. So overall, we have an income of $0.24. So by this, we can say that it is best to accept the order since we will have 0.24 income for every unit made.